Recording in progress.
Yes. Good evening, everyone. Very good evening, students. How are you all? I'm good. Okay, so I just welcome you back again to one more exciting session, one more exciting revisionary session wherein we'll be targeting the topic of capital structure today. Okay. So before that, small doubt in RTP. You just can just wait for a moment. Let me complete the session, and towards the end of our session, I'll take your doubt. Is it okay? Yeah. Okay. So capital structure. Uh, let me just give you a brief thing what it comprises of. The capital structure basically has got two parts. One is a capital structure problems, and another is capital structure theory. Capital structure problems. We know we calculate over there break-even point, right? And capital structure problems, we calculate the break-even point. Then we calculate the indifference point, right? And then we also look into the questions wherein we are, wherein we, try to identify which plan is to be chosen, right? So we were also involved in choice of financial plans. Okay. And then on the theory side, we have got certain theories of relevance, theories of irrelevance. Like we have net income theory, net operating income approach. Then we have Modigliani-Miller arbitrage model. We've got the traditional model also, right? These are certain concepts that we have in the capital structure. Now, obviously, this session, since we are just looking for the revisionary part, we are focusing on the questions aspect. So let me just take a few questions so that we are able to revise all these concepts. Okay, so let's take a look at the capital structure. Okay, let's look at this first question, guys. The GT Limited is willing to expand its business, for which it requires an additional finance of 50 lakhs. We need a finance of 50 lakhs. At present, the capital structure of the company is 7 lakh equity shares of rupees 10 each, 10% debentures 63 lakh, 12% term loan 54 lakh, retained earnings is 1 crore 30 lakhs. At present, the company's EBIT is 54 lakhs. However, the company after expansion expects a return on investment 2% greater than the present return on investment. So when we are going for the expansion, post expansion, what we will observe is that the return on investment is 2% more than the present return on investment. Income tax rate is 30%. Following two options for getting additional finance are available. First, to raise funds as term loan at 12%. Okay. And the second is to raise funds by issuing 1 lakh equity shares or rupees 10 each, and the balance by issuing 11% debentures at par. Okay. So required, find out the market price of shares if the P ratio is 10 and recommend the suitable option of raising funds with a particular reason. Okay. So we have to find out the market price of shares if the P ratio is 10 and recommend the suitable option of raising funds with a particular reason. Okay. So first we need to write down what is our existing capital structure, on that what is the level of EBIT, adding 2% return on investment on that. Okay, so let's just write down the existing capital structure. We're looking at this question 1. Capital structure will talk of existing existing. We have equity share capital, right? We have got the equity share capital. We have got the reserves, 10% debentures, 12% term loan. So existing capital structure is going to 7 lakh equity shares. So 7 lakh equity shares of rupees 10 each, which is amounting to 70 lakh. Reserves is 1 crore 30 lakhs. 10% debentures is 63 lakhs. And 12% term loan is 54 lakhs. Okay. So total capital that we have is just bring the calculator. So total capital is 70 lakh plus 1 crore 30 lakh plus 63 lakhs plus 54 lakhs is 3 crore 17 lakhs. Okay. 3 crore 17 lakhs. Existing. We have an existing capital structure of totaling to 3 crore 17 lakhs. Okay. Now, on this total capital, we have a EBIT of 54 lakhs. Now the question is if EBIT is 54 lakh, what is the return on capital employed, guys? Can you tell me? Your EBIT is 54 lakh on a capital of 3 lakh 73 crore 17 lakh. What is the return on capital employed? Yeah. Is it 17.0347? Yeah. So the company after expansion, it expects that rate of return on investment will be 2% greater than the present return on investment. Income tax rate is okay, 30%. So it's like 70 lakh plus 63 plus 54, 130. So total 317. So we can say that it is 54 lakhs divided by 3 crores, 17 lakhs. 17.0347. 17.0347%, right? This is the existing capital. Existing return on capital employed. Now we are planning for an expansion wherein we are talking of getting the funds at 12%. So following two options for getting additional finance is considered. One is to raise the funds by 12%. Obviously, 50 lakh is the additional amount that we need. And the second is by issuing equity shares. Okay, so let's talk of plan 1 and plan 2. Existing, we have plan 1 and plan 2. Now, plan 1 is a debt plan, and the next plan is debt and equity. Next plan is debt and equity. Okay. So in plan 1, when it is fully debt, of course, everything remains same, which is 70 lakh, 1 crore, 30 lakh, this 63 lakhs, then this is 54 lakhs, and we are going for fully debt. So debt is like 50 lakh additional finance is debt at 12%. So we'll say 12% debt. This 50 lakhs. Total capital will become 3 crore 67 lakh. 3 crore 67 lakh. Okay. Second is debt equity. Now in this debt equity, we have some sort of equity and some sort of debt. So they're saying to raise funds by issuing 1 lakh equity shares of rupees 20 per share and balance by issuing 11% debentures at par. Okay, so we are going to have another type of debenture in the third plan, which is 11% debenture. Because in the second plan, we were raising funds with term loan, another term loan at 12%. And now over here, we have 11% debentures. So how much money are we going to raise by way of equity? 1 lakh into 20. To raise funds by issuing 1 lakh equity shares of rupees 20 per share. So 1 lakh equity shares are going to be issued for a price of 20 per share. We can definitely say 20 lakh is arranged by way of equity. So, but obvious, what will be the amount that will be raised by way of these debentures? 30 lakhs, right? So, you can say debentures are going to be worth 30 lakh. Acha, equity shares. How many equity shares we are issuing? We are issuing 1 lakh equity shares. So, if it is 1 lakh equity shares, this is going to be 80 lakh. 80 lakh equity shares. What are the reserves then? 1 lakh equity shares. Reserves will also increase by 10 lakh, right? So 1 crore 40 lakhs. Rest debentures, which is 63 lakhs and 54 lakh will remain as it is. This total becomes 3 crore 67 lakhs. Now, return on capital employed. What have they specified about return on capital employed? They said that return on capital employed or return on investment is going to be 2% greater than the present. So if it is going to be 2% greater than the present, you can see this will be 19.0347%. And this is also 19.0347%. Okay, return on capital employed is going to be this. Now we can definitely have the income statement made out. EBIT, from that you subtract interest, you get PBT, less tax, then you get then you get PAT. From this you subtract the preference dividend, and then you have net profit for equity shareholder. You divide this by number of equity shares, and they're saying the P ratio is going to be 10. Is going to be multiplied by P ratio to get market price per share. Okay. Now, with this return on capital employed, we can get the EBIT numbers. What is the EBIT number over here? Of course, this is 54 lakhs, and this is going to be 3 crore 67 lakh. into 19.0347%. That's like 69 lakh 85 730 35. 69 lakh 85,735. 69 lakh 85,735. Okay. Now from this, we are going to subtract the interest, then get the PBT, tax, PAT, and everything. And P ratio is given in the question to be 11. Sorry, P ratio is 10. And under each of these scenario, you have to calculate the market price per share. Can we complete this statement, guys? Can we complete this statement and give me the market price? Yes. Sure. Complete this statement and give me the market price per share, guys. Okay. So interest will be 6,30,000, 54 lakh into 12%, 6,48,000 plus 6,30,000. So this is 12,78,000. Interest in the second plan is 54 lakh into 12%, which is 6,48,000. I mean, interest of original will remain same, 12,78,000. 12,78,000 plus 50 lakh into 12%, which is 6 lakh. 18,78,000. Then we have 54 lakh. I mean, this is 12,78,000 plus 3,30,000. 16,08,000. This is 54 lakh minus 12,78,000. 41 lakh 22,000. 69 lakh 85,735 minus 18 lakh 78,000. 51 lakh 7,735. 69 lakh 85,735 minus 16 lakh 8,000. 53 lakh 77,735. Okay, so these are the PBT numbers. Now the tax is at what rate? Tax is at 30%. So let's subtract the tax figures. 41 lakh 22,000 into 30%, which is 12,36,600. So that's 41,22,000 minus 12,36,300. 28,85,400. Then 51,07,735. On that, you have 30%, which is 15,32,321. 51,07,735 minus 15,32,321. 35,75,414. 53,77,735. On that, you have 30%, which is 16,13,321. We have 53,77,735 minus 16,13,000. 13,321. That this has 37,64,414. So there's no preference dividend involved in this. So this entire amount is profit for equity shareholders. So 28,85,400, 35,75,414, 37,64,414. Divided by number of equity shares. Number of equity shares is 7 lakh in first two cases and 8 lakh in the last case. 7 lakh, 7 lakh, and 8 lakh. So we get the EPS numbers. EPS is 28,85,400 divided by 7 lakh, which is 4.122. 35,75,414 divided by 7 lakh, which is 5.1077. 37,64,414 divided by 8 lakh, which is 4.7055. And since our P ratio is 10, right? So since the P ratio is 10, we can definitely say market price is 41.22, 51.08, and 47.05. So which of these three plans, I mean, should I continue with the existing plan or should I shift to a new plan? Of course, we should shift to a new plan and we should raise the money by way of the plan one. We should raise money by way of the first plan, that is by way of 12% debt. Did you get it, everyone? 51.08. Okay. %11 debentures plan. How can we take 30 lakhs, Dhanush? Because in the second plan, you're raising equity. You're issuing 1 lakh equity shares at a price of 20 each. So 20 lakhs is basically raised. So remaining 30 lakhs will be by way of 11% debentures. Got it? Remaining 30 lakh is by way of 11% debentures. Perfect. Okay. So that's question number 1 for you guys. Now, let's look for the question number 2. Interest part on which value? Interest will be on all the values. Interest will be on debentures, term loan, and debentures. 10% debentures, 12% term loan, and 11% debentures. So all three of them are accounted for interest payment. Okay. Okay. Let's look at this question number 2. So in question 2, we have a EBIT number of 2 lakh 80. Interest on debt is 40,000. EBT is 2 lakh 40. Less income tax is 1 lakh 20. And you have a PAT of 1 lakh 20. Number of equity shares is 30,000. Earnings per share is 4. Price to earning ratio is 10. The company has reserves and surplus of 7 lakh and needs 4 lakh further for expansion. So already it has got 7 lakh in reserves, and also it will be having equity shares and also some amount of debt. It's requiring additional 4 lakh for expansion. There is no change in return on capital employed. You are informed that a debt, which is debt upon equity ratio, this ratio higher than 40% will push P down to 8. So P will reduce to 8 if our debt to total capital, debt ratio or debt to total capital is more than 40%. It will reduce our P ratio to 8 and raise the interest rate on additional borrowing to 12%. So any additional amount that you borrow is going to be costing you 12%. You are required to ascertain the probable price of the share if the additional funds are raised as debt. Okay, additional funds are raised as debt, and if the amount is raised by issuing equity shares at the ruling market price. If the amount is raised by issuing equity shares at a ruling market price. Okay. Yeah. So we have got two choices. One is by way of debt, and another is by way of issuing equity shares at a ruling price. Now, so ruling price is basically 4 into 10, so basically 40 rupees. Right. So would you like to solve this first, and then I do it for you, or should it be a case that I should solve it right from the start? We'll solve. Yeah. Okay. Perfect. Just do one thing and just add this additional thing over there. Okay. Hmm. Yeah, give it a try. Can actually put up a timer for you so that we can solve it in a time bound manner. We have this question number 2 timer. Yeah, 8 minutes is sufficient. Please solve it, guys. Try to get the answer for this. PDF of capital structure, and I have already shared. You can find it in the BOS portal on the session on the BOS portal itself. I have shared, so you should be able to access it. It's not there. Capital structure and cost of capital. I'll just see and make sure that it is shared with you. Okay, I'll do that. Don't worry. Okay, I think a couple of people have got the answers. Okay, now question number 2. So we have EBIT, interest on debt, and all things are given. Now additional funds are to be raised. So first I need to check what is the existing capital structure and what are the planned capital structures. Okay. So we'll talk of existing, then we'll have plan 1 and plan 2. Okay. So equity share capital, reserves, debentures, which are of course 10% debentures. So existing capital consists of number of equity shares is 10. I mean, sorry, 30,000 equity shares and 10 rupees the face value. So 3 lakh is the equity share capital. And it says that reserves are worth 7 lakh. The amount of debenture that we have is 40,000 for interest is the 40,000 for a 10% rate. So of course, debentures are going to be 4 lakh. So we have a total capital employed of 14 lakhs. In plan 1, equity share capital, number of equity shares, we say it is, first plan is to raise by way of debt and second is by way of equity shares. So if you're raising it by way of debt, the share capital will remain 3 lakh, reserves will be 7 lakh. Okay. And debentures are going to be 4 lakh. And we are going to have the additional debt. Additional debt, which is going to be, we're going to raise how much? The amount to raise, we need 4 lakh. Additional debt is going to be 4 lakh. The total capital will become 18 lakh. But one thing we need to check over here is debt upon debt plus equity. Okay, debt upon debt plus equity, this is going to be 4 lakh upon 14. So 4 upon 14 is 28.57%. In the second case, it's going to be 8 upon 18. 8 divided by 18, which is 44.44%. And since this is exceeding, this 44.44% is more than the 40% limit, what is going to be the cost of new debt? What is going to be the cost of new debt? What is going to be the cost of new debt? Interest rate on additional borrowings or debentures is going to be 12%, right? If your ratio is greater than that. So this is going to be at 12%. Then second plan we have wherein we are going to issue equity shares at the existing prices. So existing price is 40. So in plan 2, how are we going to get the number of equity shares? Number of equity share in plan 2. Number of equity share in plan 2 will be 4 lakh divided by 40. Right? Because ongoing market price is 40 because you have the earnings per share as 4 and the EPS is 10. So ongoing, you get this as 4 lakh divided by 40, which is 10,000 plus old number of shares, which is 30,000. So you have total as 40,000 number of shares, so which will be, of course, translating to a share capital of 4 lakh. Reserves of 7 lakh are there. Now, on those 7 lakh, we'll definitely add the securities premium. So we'll say securities premium will be number of shares is 10,000. On that, you'll have a securities premium value of 30 because each of them is going to be issued at 40. So securities premium is going to be 3 lakh. So our reserves is going to become 10 lakh and debentures is still going to continue at 4 lakh and the total is 18 lakh. Okay, so we got the capital structure of all the things. Now we will start with EBIT because the EBIT is just saying it's for expansion. So how do we get to know what will be the EBIT number? So EBIT is 2,80,000 in this case. 2,80,000. So what's the return on capital employed? What's the return on capital employed? 2,80,000 upon 14 lakh, which is 20%. Right? Return on capital employed is 20%, correct, guys? Because currently you have 2,80,000 on a total investment of 14 lakhs. So that's 20%. And since the question is not specified that what will be the impact on return on capital employed, we can safely assume that it's going to be same for all of them. So when it's 18 lakh, we'll have the EBIT as 3,60,000. Right? When it's 18 lakh, the EBIT is going to be 3,60,000. From this, we will subtract interest. The interest is on 4 lakh 10%, which is 40,000. And then on the other side, you have 4 lakh 10%, 40,000 and 12%, 4 lakh 48,000. So that's 88,000. And here also it is 40,000. So you have profit before tax, which is 2 lakh 40,000, 3 lakh 60 minus 88,000, which is 2 lakh 72,000. And then this is 3 lakh 20,000 PBT less tax. What is the amount of tax payable? Tax is at 50%. So 1,20,000 the tax paid. Here it will be 1,36,000, 1,60,000. And we get a profit after tax of 1,20,000 1,36,000, 1,60,000. We divide this by number of equity shares. In the first case, number of equity shares is 30,000. Second case also it is 30,000. In last case, the number of equity shares is 40,000. And then we have the EPS numbers. 1,20,000 divided by 30,000, which is 4. Then 1,36,000 divided by 30,000, which is 4.533. Then you have 1,60,000 divided by 40,000, which is 4. Now, P ratio. In the first case, the P ratio is 10. Second case, P ratio will be 8. And third case, again, it's going to be 10. So market price is 40. Then we have 4.533 into 8, which is 36.2664. And then this is 40. So which of the two plans? If given a choice between two plans, I'll definitely go for the second plan. So after expansion also, our market price per share is going to remain same. Ascertain the probable price of the share. Anyways, they're saying in both the cases, we were supposed to determine the price of the share. So existing is 40. Plan 1, it's going to be 36.26 and plan 2, it's going to be 40. Got it? Everyone? Did you get it? Did you get the market price per share? Yes. Okay. Perfect. Okay. That's question number 2, guys. Okay, now let me just try out this question for you. Question number 6 from here. Let's paste it over here. Yeah, question number 6. Just read the question and just tell me if you would like to try or shall I solve it? Try out this, just read the question number 6 and then let me know whether you can solve it or would you like to try or shall I simply take it over? Will try? Yeah. Okay, great. Just try it out. Just give you maybe a minute lesser time. 7 minutes. Yeah. Try out question number 6. Try to solve it in graph. Okay, so we got the EPS. Plan 1, it is 15.83. Plan 2, 18.125. Plan 3, 16.4062. Okay, let's just wait for some more answers maybe. Okay, let me just get started with this. Question number 6. Chargy Steel Limited requires 25 lakh for a new plant. This plant is expected to yield earnings before interest and taxes of 5 lakh. So this investment is going to provide us a EBIT of 5 lakh. While deciding about the financial plan, the company considers the objective of maximizing earnings per share. It has three alternatives to finance the project: by raising debt of 2 lakh 50, or 10 lakh or 15 lakh, and balance in each case by issuing equity shares. We are looking at all the plans by some component of equity and debt. The company's share is currently selling at 150, but is expected to decline to 125 in case the funds are borrowed uh, in excess of 10 lakh. So share price is going to fall to 125, they're saying. The funds can be borrowed at a rate of 10% up to 2 lakh 50, at 15% over 2 lakh 50 and up to 10 lakh, and 20% over 10 lakh. So tax rate is 50%, unless which form of financing should the company choose? So let's first write down the capital structure. Let's first write down the capital structure, guys. So capital structure, we've got plan 1, 2, 3. Right? Therein we're talking of equity, um, and debt. Okay. So in plan, we're going to raise debt of 2 lakh 50, 10 lakh, or 15 lakh. So debt is going to be 2 lakh 50 in first case, 10 lakh in second case, and 15 lakh in third case. And of course, the balance is going to be equity because total amount that we want to raise is 25 lakh. So balance equity is going to be 22 lakh 50. Then you have out of 25, 10 lakh is it. So 15 lakh equity, and the last case 10 lakh equity. Okay. Now let's also get, this is okay, 25 lakh total capital employed is 25 lakh. Total capital employed, we got it as 25 lakh. Then we say that number of equity shares. So we need to have the market price per share. They're saying that the market price is going to be currently 150 and expected to decline to 125 in case the funds are borrowed in excess of 10 lakh. So market price is 120, sorry, market price is 150 and it will decline to 125. What will be the number of equity shares? So 22 lakh 50,000 divided by 150. In first case, the number of shares is 22 lakh 50,000 divided by 150. That's 15,000. Then it is 25 lakh divided by 150. So again, here the number of, sorry, not 25 lakh, my bad. 15 lakh divided by 150, that's number of shares is 10,000. And in the last case, 10 lakh divided by 125, which is 8,000. Market price per share, number of equity shares. Now, we've got the EBIT. EBIT is going to be 5 lakh in each of the cases. Right, so now EBIT is 5 lakh. From that, we are going to subtract the interest. Now, interest, remember they have given us slab-wise interest. So I need to subtract the interest also on the similar lines. So interest, we will say up to, there are certain limits given, up to 2 lakh 50, 2 lakh 50,000 to 10 lakh, right? And then above 10 lakh. Okay, so debt is 2 lakh 50,000. The rate of interest is 10, 15, and 20%. So this is at the rate of 10%, at the rate of 15%, and at the rate of 20%. 10, 15, and 20%. So 10% Interest on 2,50,000 will be 25,000. Next year it will be 25,000, and 2,50,000 to 10 lakh on that 7,50,000 we have 15%. 7,50,000 into 15%, 1,12,500, and then we have again 25,000, 1,12,500, above 10 lakh 20%, which is 1 lakh. When we subtract the interest, we get the profit before tax. 5 lakh minus 25,000, 4 lakh 75,000. Then we have 5 lakh minus 25,000 minus 112,500 is 362,500. 5 lakh minus 25,000 minus 112,500 minus 1 lakh, which is 262,500. That's PBT less tax. So tax rate is going to be computed at 50%. So tax at the rate of 50%, that should be 4,75,000, 50%, 4,75,000 into 50%, 2,37,500, 362,500 into 50%, 181,250, and then 262,500 into 50%, that's 131,250. We have a profit after tax figure, 4,75,000 minus 237,500, which is 2,37,500. Of course, it's going to be remaining same because the tax rate is anyways 50%. Okay. Okay, so that's the PAT number. Which form of finance should the company choose? Of course, I need to get the EPS. So for that, I'll need the number of equity shares. The number of equity shares is 15,000, 10,000, 8,000. 15,000, 10,000, 8,000. 237,500 divided by 15,000. The EPS is 15.83. Then we have 181,250 divided by 10,000, 18.125. 131,250 divided by 8,000, which is 16.41. Okay. We have the EPS numbers. Now, based on these EPS plan, which plan should we choose? Which plan should we choose, guys? Plan 1, 2, or 3? Which plan should we choose? Plan 2, right? Of course, plan 2 because it has got the highest EPS. So plan 2 should be chosen since it provides us with the highest level of EPS. Okay, good. Now, let us look for this question number 4 now, wherein we are going to calculate the indifference point, right? The indifference point. So question 4, let me just write down the capital structure values. Question 4, we have like option 1, Option 2, equity shares of rupees 10 each. Equity share capital to issue equity shares of rupees 10 each. We want an investment of 84 lakh. So plan 1, since it's going to be 84 lakh and each equity share is 10 rupees, that's going to be 8 lakh 40,000. And debt, the first case is going to be nil. So total it is 84 lakh. Second option, to avail a term loan at interest rate of 12%. But in this case, as insisted by the financing agencies, the company will have to maintain a debt equity proportion of 2:1. The company will have to maintain a debt equity proportion of 2:1. So debt equity proportion, if it is 2:1, we can definitely say that debt is going to be, since it is 2:1, so 84 lakh divided by 3, which is 28 lakh. Share capital is 28 lakhs. Okay. And debt is going to be the balance thing, which is, okay, what's the cost of debt, by the way? 12%. Balance 84 lakhs minus 28 lakhs, which is 56 lakh. So I've got the total capital employed to be 84 lakhs. Total capital employed is 84 lakhs. Now we have to get the point of indifference between them. Now, if I want to say EPS of plan 1, that will be level of EBIT, right? Minus 0, because there's no debt, into 1 minus tax rate. So the tax rate is 30%. So 1 minus tax rate upon number of equity shares is 84,000. This was 84 lakh, right? And each of them is having a face value of 10 each. So 8 lakh 40,000 is the EPS one. EPS of second is EBIT minus interest of 12%. 56 lakh into 12%. 56 lakh into 12%. That's 6 lakh 72,000 into 1 minus 0.3 upon 2 lakh 80,000. Okay, so that's 0.7 EBIT upon 8 lakh 40,000 is equal to 0.7 EBIT minus 67 lakh or 6 lakh 72,000 into 0.7, 4 lakh 70,400 upon 2 lakh 80,000. Now we can subtly cancel out these 4 numbers from both sides, and 28 and 84, do they, what happened? Cancel out easily, yeah. We can reduce this. This is 3 -za. We have 0.7 EBIT is equal to 2.1 EBIT minus 4 lakh 70,400 into 3, which is 14 lakh 11,200. Bring EBIT terms on one side. 14 lakh 11,200 is equal to 1.4 EBIT. 14 lakh 11,200 divided by 1.4. So EBIT is 10 lakh 8,000. When I say 10 lakh 8,000, this is exactly your indifference point. Is the level of EBIT at which EPS of both plans is equal or same. Okay, are we good, everyone? Did we get this indifference point? 10 lakh 8,000. Got it? Okay. Perfect. So that brings this question number six, I'm sorry, question number four to an end. So now with that, let's just take a break now, guys. Let's take a break and post that we'll continue with the remaining questions. Okay, so let's take a break, guys. Okay, shall we continue? Are you all there, everyone? Okay, so we have done like question number 1, question 2, question 3 is pending. Okay, let's do it later on maybe. Fourth is done now. Question number 5. Let's go ahead with question number 5. And then after that, we'll go for 7 and 8. Question 5. Theta Limited is expecting an annual earning of 3 lakhs before paying any interest and taxes. The company has 10 lakhs of 10% debentures in its capital structure. The capitalization rate is 12.5%. You're required to calculate the value of Theta Limited as per NI approach. Also compute the overall cost of capital. Theta Limited is expecting an annual earning of 3 lakhs before paying any interest and taxes. We are having a EBIT of 3 lakhs. Company has 10 lakhs of 10% debentures in its capital structure. So we're having 10 lakh of 10% debentures. The capitalization rate is 12.5%. We have to calculate the value of Theta Limited as per NI approach and also the overall cost of capital. Okay. So we have the information about EBIT, which is earnings before interest and tax, which is 3 lakhs. Company has 10 lakh 10% debentures. So we have value of debt as 10 lakh. The capitalization rate is 12.5%. Now, when we are saying capitalization rate is 12.5%, what capitalization are we really talking of? Are we talking of the KO or is it KE? Since it is net income approach, we are going to take that as, of course, KO, because capitalization is generally for the value of the business. KO is 12.5%. You're required to calculate the value of theta as per NI approach. So since we have KO of 12.5%, can we get the value of the firm? Can we get the value of the firm? So value of the firm is EBIT upon KO. EBIT is 3 lakh and upon KO is 12.5%. So what's the value of the firm? 24 lakh, right? Is it? Well, is it going to be this way? No, guys. Whenever we're talking of net income approach, the capitalization rate which will be given to you, that is not the overall capitalization, that's actually the equity capitalization. Because if I'm asking you net income approach, I want you to calculate the cost of equity, and sorry, I want to calculate the KO. And if you say that 12.5% is KO, then answer is obvious, right? So we don't have to say that part. Rather, what we have been given as capitalization rate KE is 12.5%. KE is 12.5%. Now, once we have the KE, we can definitely prepare the income statement with EBIT 3 lakh less interest of 1 lakh, which will give it a PBT of 2 lakh. Okay. So PBT is 2 lakh, and of course, we can't subtract the tax from this. So PBT is 2 lakh. Now, based on this PBT, we have the value of equity as PBT upon KE. is 2 lakh upon 12%. 2 lakh upon 12%. Its value of equity is 16 lakh 66,667. EBT is 2 lakh divided by 12%, 16 lakh 66,667. To that, we are going to add the value of debt, which is 10 lakh. Then we have the value of the firm. Value of the firm is 26 lakh 66,667. Sorry, it's 12.5%. Once again, did I make a mistake? Okay, so that's 12.5. My bad. Yeah, 12.5. So this will be divided by 12.5%. So 2 lakh divided by 12.5%, which is 16 lakh. And to that, we are going to add the debentures of 10 lakh. Value of firm is 26 lakhs. We have got the value of firm. We have the EBIT. Can we get the overall cost of capital KO? Can we get the KO? Yes, of course. We can calculate the KO. KO is going to be EBIT upon value of the firm. EBIT is 3 lakh divided by 26 lakhs. This works out to be what? 11.54%. 3 lakh divided by 26 lakh, 11.54%. Eleven point 54% is the overall cost of capital. Are we getting this? Yep. 11.54% is the overall cost of capital, guys. Okay. Fine. In the question specifically should mention that it is equity capitalization, otherwise capitalization only. Since the question is asking us to use net income to calculate the overall cost of capital, I mean, so there you can't assume that this is KO, because if you say KO, the answer is obvious that 12.5% is just the answer. So obviously we can't have such a question, right? Okay. So therefore we have to think it from the other perspective now. Okay, so that's question number 5. Okay, then let's go for question number 7 over here. Question number 7. Expected net operating income of A Limited, B Limited is 18 lakhs. So both companies are having a same amount of net operating income or same amount of EBIT. Okay. So we have A Limited and B Limited. Both of them are having same amount of expected net operating income, or I can say EBIT. EBIT is same, which is 18 lakh in both cases. Of course, from EBIT, we are going to subtract the amount of interest. We will be subtracting interest only for A Limited. So on A Limited, we can say 54 lakh into 12%. which is 6,48,000. There's no interest over here. And then we have profit before tax, 18 lakh minus 6,48,000. This is 11,52,000. And here we have same 18 lakh. Determine the total market value, equity capitalization, and WACC for each company, assuming no taxes as per approach. So we have seen that there's no taxes. So our income statement stops at PBT. Okay, now whenever there is no tax scenario, what all information do we have is equity capitalization. So we have the equity capitalization for B Limited to be 18%, and we don't know what is this over here. So we have to compute the total market value, we have to compute the equity capitalization and also the WACC for each company, assuming that there are no taxes. And then we'll also have another scenario where we have taxes in between. Okay. So since K is like 18% given to us, we can get the value of equity. Right. So we can get the value of equity to be like over here, we have the PAT. So PAT upon K, 18 lakh divided by 18% is 1 crore value of equity, right? And do we have any value of debt added to it? No, right? So in that situation, we get the value of firm as 1 crore. When there is no taxes, what is going to happen with value of both entities? When there are no taxes, what is going to happen to the value of both entities? Can I say both of them are going to have the same value? So value of firm is going to be same over here, right? So we can definitely say value of firm is constant. Value of firm is constant, or value of firm is same in value of firm is same in both, or value of firm is same for both entities. Okay. Now, of course, we have got the value of firm. I can subtract the value of debt over here. What's the value of debt in A Limited? That's 54 lakhs. Value of debt is 54 lakhs. So we can get the balancing value of equity as 46 lakh. Right? So we got the value of equity, value of firm, and both for both the entities. Now we can get the KE value. KE is going to be PAT upon value of equity. This is going to be like 11,52,000 upon 46 lakh. What is this number? 11,52,000 divided by 46 lakhs, 25.04%. Right. So we got the KE. KO is anyways going to be EBIT upon value of firm. So EBIT is 18 lakh upon 1 crore. That's 18%. So we got the equity capitalization, we got the WACC, we also got the total market value. Right. So yeah. So without taxes, part is done. And we assume that there are no taxes, this particular part is done. Did you get this? Easy? Yeah. Okay. So question 7, we have got the story of without taxes is done. Now, when we have this same situation under tax scenario, wherein we have the tax situation working, right? So there, how are we going to really function? If tax rate of 40% is applicable, then we have two entities, A Limited and B Limited. A Limited and B Limited. We have got like EBIT of 18 lakh for both. Of course, on that, we are going to subtract the interest. The amount of interest was 6,48,000. We have got profit before tax from 18 lakh. We have got 6,48,000 subtracted. 18 lakh minus 6,48,000. 11,52,000. And this continues to be 18 lakhs. From this, we are going to deduct tax now. So the tax rate is 40%. If we take the tax as 40% on this 11,52,000, we're going to pay 40% tax rate, which is 4,60,800 minus 11,52,000, which is 6,91,200. Over here on 18 lakh, we have 40% tax. 18 lakh into 40%, which is 7,20,000. That's like 10,80,000. 18 lakh minus 7,20,000, 10,80,000. That's your profit after tax. Okay. That's your profit after tax. Now we can definitely calculate since the equity capitalization rate is given, K isn't specified over here, but we have a K on the other side, which is 18%. Based on this K, we can definitely get the value of equity. Value of equity will be 10 lakh, 10.8 lakh divided by 18%. 10,80,000 divided by 18%, which is 60 lakhs. If this is 60 lakh, value of equity works out to be 60 lakh. PAT is 10 lakh 80. K is 60 lakh. Now, after this, how shall we proceed further? Of course, when we take a value of debt, there's no value of debt over here. We can get the value of firm as 60 lakhs. Okay. So if the value of firm is 60 lakhs, tell me what will be how should we proceed it further? Because we have got the value of B. Now, how do I go about getting the value of A? Because unless until I get the value of A, I cannot calculate anything about the company A. Right? Yeah. Okay. Perfect. So we need to use the formula of from we're actually trying to get the formula. Get the value of uh, levered is equal to value of unlevered plus amount of debt into tax rate. Right? So value of levered will be value of unlevered plus debt into tax rate. So this value of debt will say not applicable. But when we want to calculate it, value of firm will be 60 lakh plus the amount of debt that we have in the first company is 54 lakh. That's going to be 60 lakh plus 54 lakhs into 0.3, 0.4, right? Yeah, 60 lakh, or again 54 lakhs into 0.4, 21 lakh 60 plus 60 lakh is 81 lakh 60,000. Value of firm is 81 lakh 60,000. Right? So we got the value of firm. And from this, if I subtract the value of debt, which is 54 lakh, I can definitely get the value of equity to be 81 lakh 60 minus 54 lakh, which is 27 lakh 60,000. 81 lakh minus 50, 81 lakh 60 minus 54 lakh. This works out to be 27 lakh 60,000 as the value of equity. $60 lakh becoming 81 lakh 60,000. From that, you subtract the value of debt 54 lakh. Value of equity is 27 lakh 60,000. Now, from this, we can definitely get the KE. KE will be PAT upon value of equity. Right? So PAT is 6,91,200. 6,91,200 divided by 27 lakh 60,000. This is 25.04%. %25.04%. Okay. 81 lakh 60 minus 54 lakh. Value of equity is 27 lakh 60 and cost of equity is 25.04%. KE is 25.04%. Now, once we have got the KE, what is left out to be calculated? We have got the market value, we've got the equity capital. Now WACC, yeah. Over here, KO or weighted average cost of capital, we can do it by two methods. The calculation of WACC for A Limited. We have equity, we have debt. Value of equity, no, it is 27 lakh 60,000. Value of debt is 54 lakh. Total is 81 lakh 60,000. Weights, cost, and then weights into cost. 27 lakh 60,000 divided by 54 lakh, which is 0.511, and 54 lakhs. Once again, I think there's a mistake. 27 lakh 60,000 divided by 81 lakh 60,000. Yeah. This 0.3382. Then this is 54 lakh divided by 81 lakh 60,000, 0.6618. Cost, we got the cost of equity as 25.04%. We got the cost of debt. Well, the cost of debt interest rate was given to be what? 12%, right? Interest rate was given to be 12%. So 12% we make it after tax. So this should be like what? 12% into 0.6. 12 into 0.6, 7.2%. Then we just took the weighted average, 25.04 into 0.3382, 8.4685 and 0.6618 into 7.2, which is 4.7649. 8.4685 plus 4.7649. 13.2334. 13.2334. That's weight into cost. And we can say KO is 13.2334%. Okay. Alternative way to get this is to simply use the formula of KO is equal to EBIT into 1 minus P upon value of the firm. EBIT is 18 lakhs. 18 lakhs into 1 minus tax rate is 0.4 upon value of firm is 81 lakh 60,000. We have 18 lakh into 0.6 divided by 81 lakh 60,000. You can see 13.23, same answer you're getting. So either of the ways, you can calculate using tabular weighted average cost of capital, or you can get it by simply using the formula of EBIT 1 minus T upon value of firm. Are we clear, everyone? Are we getting these numbers? Yeah. Fine. So there is this question number 7. Approach with the taxes. Okay. Question number 8 now. Good. Question number 8. Just have a look at it for a minute. Okay. So data relation to two companies, Karna Limited and Arjun Limited, belonging to the same risk class are as and when. So both the companies are into the same risk class. The only difference is regards to their financing. Karna Limited has got 90,000 equity shares. This is some mistake here. This is 90,000 equity shares and 1,50,000 shares are with Arjun Limited. Market price is 120 and market price is 1.2 and 1. 6% debentures are 60,000 with Karna and Arjun has got no. So total capital you can see it's 1,50,000 for both of them. EBIT is also same for both. There are no taxes. We have an investor who's holding 10% stake in Karna Limited. What is the benefit or loss to him if he switches his holding to Arjun Limited? What will be and when is this arbitrage process going to end? So this is we're talking of Modigliani-Miller arbitrage model. Okay, so we're talking of arbitrage model. We need to check what's the benefit that the investor is going to get. Let's first write down certain basic concepts, basic part of this question. Question number 8. We have Karna, we have Arjun. EBIT is 18,000 less interest. Interest is going to be on 60,000, 6%. So 3,600 here. And in Arjun, there is no interest. So we have PBT of 18,000 minus 3,600 is 14,400 and PBT is 18,000. And we don't have any taxes coming up over here. So, and we already have, like, for this market price of share, it is 1.1 and here it is 1. So we can say value of equity is going to be 1.2 into 90,000. 1.2 into 90,000, which is 1,08,000. And on the other side, it is 1 into 1,50,000. Okay. Add to this value of debt. Value of debt is 60,000 and here it is nil. So the value of the entire firm is 1,68,000 and this is 1,50,000. 1,68,000, 1,50,000. Now, out of ideally both the companies should have the same value. But since there's a value disparity, which of these two firms is overvalued? Guys? Which of these two firms do you believe that it is overvalued and which is undervalued? Right. So this is Karna is overvalued. And the other side, Arjuna is a undervalued firm. Karna is overvalued, Arjuna is undervalued. Now, based on this, one company being overvalued, other company being undervalued, based on this, what can we really talk of? Where would the investor switch from? So will the investor switch from Karna to Arjun or from Arjun to Karna? Of course, from overvalued to undervalued, right? So consider the investor with 10% share in Karna Limited. We are considering an investor who is having a 10% share in Karna Limited. So when we are looking at this investor who is having a 10% share, how is this investor going to gain and what is the benefit that we are going to have? So consider an investor with 10% share in Karna Limited. Let's go step by step. First step, what will be the realization from sale of stake in Karna Limited? What will be the realization from sale of stake in Karna Limited? Can I say it's 1,68,000? That's the value of the entire firm. But 10% stake is in the equity shares, right? So equity shares are valued at 1,08,000. 1,08,000 into 10%. So we are going to realize 10,800. We are going to realize 10,800 from the sale of stake in Karna Limited. We are going to realize 1,08,000 into 10%, which is 10,800. right? That's the first step. Second step is we take this money and buy the stake in Arjun Limited. But we already had like 10% stake in Karna Limited, and when I switch to Arjun Limited, the risk profile is not going to be remaining same, right? Because when we were investors in Karna Limited, we definitely had an investment worth 10,800, but on this investment of 10,800, there was an indirect loan on us by way of 10% share in the liability of. Like if we are owning 10% of the company, we are also liable for 10% of the liabilities of the company, right? Yes. So if you are having shares of a particular company, you indirectly are actually also liable for 10% share in the loan of the company, right? So when we are having 10% ownership of the equity shares, we are also liable for 10% debt of the company. So in step 2, what we do is borrow at, what's the rate of interest applicable here? Borrow at 6%. So borrow at 6%. So realization from sale of stake in Karna is 10,800. Then we are going to say borrow at 6%, right? So we are going to borrow at 6%, an amount equal to 10% of loan of Karna Limited. We're going to borrow at 6%, an amount equal to 10% of loan of Karna Limited. Borrow at 6%, an amount equal to 10% of loan of Karna Limited to match the risk. To match the risk of earlier investment. Because earlier, for your investment of 10,800, you also had 10% stake in the loan, right? You were also liable for 10% loan. So here it is going to be 60,000 into 10%, which is 6,000. You borrow 6,000, you also withdraw your 10,800 money. And then in step 3, you're going to invest the total amount in Arjun. So what's going to be the total amount of investment? 10,800 plus 6,000, which is 16,800. To invest the total amount in Arjun Limited, we can say 10,800 plus 6,000. Okay. Then finally, okay, in this third step itself, we compute the percentage ownership. Percentage ownership will be 16,800 divided by total value of Arjun, which is 1,50,000. So what's the ownership percentage that we are getting? 16,800 divided by 1,50,000, which is 11.2%. Percentage ownership is 11.2%. Then fourth step, finally the fourth step, we say what is income that we are getting, income from investment in Arjun. Because being an investor in Arjun Limited, will be getting access to 11.2% of the profit. So 11.2% of profits means the profits are, what is it, 18,000? So 18,000 into 11.2%, right? So 18,000 into 11.2%, which is 2016. 2016 is the income from investment that we have in Arjun Limited. Of course, I cannot take this entire income because I need to pay the interest also. So interest on loan, because we had borrowed that 6,000, right? So on that 6,000, we are going to pay interest at 6%, which is 360. So 2016 minus 360 is 1656, right? So interest is something that we subtracted, 1656. So 2016 divided by the interest on loan, which is 1656. That's the interest on loan, 2016 minus 360, which is 1656. That's the income. Now, in step number 5, I'll just try to recall what was my income earlier when I was an investor in, right? So in step 5, we will say income that was earned, income that was earned on, income that was earned on investment in Karna Limited. Now, what was the income that we had in the Karna, value of Karna Limited? Profit share was 14,400. So on that 14,400, we earned 10%, which is 1440. So are we having a increased income when I switch from a levered company to an unlevered company? Yes. So we can say increase in earnings. Increase in earnings will be 1656 minus 1440, which is 216. Right? So increase in earnings is 216. So is the investor then going to shift from Karna to Arjun? Yes. The investor is going to switch from levered entity to unlevered entity because it results in higher income. Okay. Are you good, guys? Yep. Okay, fine. So that is this question number 8. Someone was asking for some RTP question query. It was Tejaswin, right? Yeah, Tejaswin. Which question are you talking of from the RTP?
Good evening, sir.
Yeah.
Sir, I have a doubt in only one part. Sir, in RTP September 25, there is a question on capital structure,
Okay.
and that question is having we have to calculate the capital structure, and then by using the weights we have to calculate KO. Sir,
Okay.
I am having the doubt in calculating of KD. Sir, it is an irredeemable debt. So, sir, when interest into 1 minus tax rate upon
Uh,
net proceeds. But,
uh,
sir, in the net proceeds, they have not taken like the flotation cost which they have given.
Flotation cost is not taken.
Yes, sir.
Let me just look at the RTP question. Then I'll be able to know which question. Hmm, September 25.
Yes, sir.
in
Sir,
this,
it's on
which
page number 6.
question number 6?
Page number 6, question number 6.
Yeah, this one.
Yes, sir. Sir, there is equity financing, debt financing, and a flotation cost of 2% on face value. So, sir, when we will
Rotation
calculate,
cost on debt is 2% of face value. Okay. The lender
so,
imposes a debt covenant limiting the interest coverage to a minimum of 2.5. Okay.
so
Hmm.
sir, when we will calculate the KD, it will come like 8.4 divided by
KD,
100.
but why do we need KD over here? Are we asking for?
Sir, we have to calculate KO
Okay, we have to calculate
in the
KO.
last part. In the last part, we
Okay.
have to calculate KO. So, sir, when
Okay.
we'll calculate KD, it will come like 8.4 divided by 100 minus 2%. That is
Wait, that's
divided
question
by,
number 6, right?
yes, sir. Sir, it will be around 8.5%, but they have taken directly 8.4.
Debt, they have taken flotation cost. No?
Sir, in calculating the option they have taken, but while
Okay.
calculating KD as well, we have to take like net proceeds, no?
Okay, while calculating KD, debt option, calculating weighted average as cost of equity.
They have directly taken it, sir, 8.4, but according to me, it should be
Where is it?
8.5.
After tax cost of debt is 12% into 1 minus it. This is 8.4%. K is and KD is 8.4%. The flotation cost is given to us.
2% on face value.
Okay, तो ये 12% का what is the terminology? Terminology. Lender imposes a limiting interest coverage, EBIT to interest minimum. Flotation cost is 2% of face value and borrow 50 lakh at 12% interest. Hmm. But I think is it impacting like compute the WACC under each option? Okay. So flotation cost is 2%. Yeah, I think that should be adjusted for. Yeah. So,
So, sir, it would be 8.5 and 142%.
yeah. You need to subtract the flotation cost in the denominator.
Sir, in this RTP, I have one more doubt in case scenario 1, like calculation of capex. Sir, what is it?
Case scenario one,
Yes, sir. It is like an investment decision question, but I am not able
uh,
to understand it.
calculation of
Capex.
capital expenditure. Capex is basically capital expenditure that you're going to put in.
So,
Planning to
sir,
issue 15.
so, sir, we
Please.
have to like calculate capital expenditure. Like I am able to understand the question that with inflation they are growing. So we have to calculate the capital expenditure and
No, it's
normally the
just like
cash
it's
flow.
an investment decision question. So you need to calculate the CFAT, right? You need to calculate the terminal value or the last year value.
And then
Then
IRR.
it, yeah, total NPV and IRR, same thing. Yeah.
Sir, in that question, the capex point only there. Sir, 2 points. I am having a problem. Like, sir, in calculation of capital expenditure of first the workers and the manpower. That is the manpower, and sir, the local authority revenue. They have taken like 15%, but actually in the question it is given 5%. In the answer,
Where?
they have,
Which one?
sir, the point number one, 2, 3, 4, 5, fifth point.
The equipment investment varies
No,
with
sir,
number of
fifth
branches.
point from page number 2. Fifth point from page number 2. Page 2, fifth point.
Page 2, fifth point. Mint has entered an agreement with local authority and has agreed to share 5% of the revenue with the same.
Yes, sir.
Okay.
But, sir, in the answer, they have done it from 15%.
Okay. Let me check the answer.
Sir, the first point.
Share of local authority.
It's a 15% of the revenue.
Yeah, should be 5%. Yes.
So, sir, what to do? Then we have to change the question only.
We'll just change the question. Yeah. We'll check it. We'll get it checked and probably rectified.
Okay, sir. And sir, one small doubt, sir, in
Hmm.
Modigliani or that, when sir we go from unlevered form to levered form,
Okay.
like unlevered form is overvalued, and we go to levered form. Then, sir,
Hmm.
when at step number 3, when we have
Hmm.
to like match the risk. So, sir, we will
Hmm.
also invest in debt. So, sir, that debt ratio and the capital ratio will be the capital structure ratio, no, of
Yeah,
the
correct.
company.
Yes,
Or,
yes.
sir, we have to do like a normal ratio, like 50-50%.
No, no, no. It will be the in the ratio of capital structure only.
In the ratio of capital structure. Yes, yes.
Yes, whatever
These
is the
are the
capital structure of the previous entity, or you can say whatever is the capital structure of the new entity, you need to follow the investment in that pattern itself.
okay, sir. These were the only doubts. Thank you, sir.
Oh, okay. Okay, guys. So I think there's one question which is left out over here. Yeah. Now we have depending on the cost of project, the cost of debt and cost of equity is given, and we have like the cutoff rate for two projects are given to be the cost of projects is 15 lakhs and 26 lakh. Weightage is given to be 3:7. The company is presently considering several alternative investment proposals costing less than 25 lakhs. The company will always raise the funds required without disturbing its current capital structure ratio. So without disturbing its current capital structure ratio, the company is going to raise the funds. Cost of projects up to 5 lakh. We can say cost of debt is 10% and cost of equity is 12%. So up to 5 lakhs, above 5 lakhs, and up to 10 lakhs, we have all those costs given to us. We need to just get the weighted average cost. We can easily get the weighted average cost over here by simply taking weight of debt into cost of debt plus weight of equity into cost of equity. And what is the weightage that we are going to follow? This is obviously weight of debt is going to be 0.3, weight of equity is going to be 0.7. Okay. So with that, can you just give me what will be the overall cost of capital numbers over here? For the first case, what is it going to be? 0.3 into 10% plus 0.7 into 12%. So that's like 0.3 into 0.1. Okay, that's 11.4%. Then in the second case, what's the weighted average cost of capital? 13.05. Okay. Then third case, in the third case, what's the weighted average cost of capital? 14.4%. Fourth case, what's the weighted average cost of capital? 15.4%. Now, out of these four, uh, which cost will be applicable for project number one? Because project number one is having an investment of 15 lakhs. It falls into this third category, which is 14.4%. The cutoff for the two projects, we can say it's 14.4% for this one, and for 26 lakh, it's 15.4%. Right? So for 15 lakhs, you will need a minimum return of 14.4, and for 26 lakh, you'll need a minimum return of 15.4%. Then the next part says if the project is expected to offer an after-tax return of 13%. So for 13%, which capital structure, or what should be the maximum size of the project which will be applicable in case of after-tax return of 13%? Of course, 5 lakh, right? If the project is having a cost up to 5 lakh and offering a return up to 13%, then it's going to be feasible, because in all other cases, the cost is going to be more. So only in the first case, the project is going to be acceptable. Okay. Done. Easy. Fine. So with that, we are done with the revision for the chapter of capital structure also. We have revised like ratio, we have revised the cost of capital, and also the capital structure. So with that, let's just call it a day, guys. Thank you for attending my session and giving me a silent hearing. Thank you so much, guys. All the best. Bye-bye. Good night. Done. Yes.